Hi everyone. Today we'll be discuss on the topic financial analysis. So when we talk about financial analysis, basically it will be refer in evaluation of the company performance. Each of the company basically they will apply this kind of ratio in order to know whether the company in good performance or poor performance. There is a few indicator that will be determine whether the company currently running smooth, running in good condition by applying this kind of financial ratio. So basically, this kind of financial ratio will be using by first from the investor perspective, second based on the company, which is the manager itself will be run this kind of financial ratio in order to know whether the company in good performance or not. Sometimes they will be using by business contact in order to know whether the company or those that they are applying in current or good condition. So basically, for the financial ratio, we have a few criteria. So we move to the first one, which is under liquidity ratio. So when we talk about liquidity ratio, we want to know exactly whether those company current asset easily to be converted into cash. Or another perspective, basically under liquidity ratio, we want to know whether the company asset able to cover their own liability. So we moved under liquidity ratio. For the first item under liquidity ratio, we have current ratio. So basically, when we want to talk about current ratio, so current ratio is whereby we want to know how many times those current asset able to cover, able to pay their own current liability. So that's why we'll be run this kind of formula or this kind of ratio. So basically the formula for the current ratio is current asset will be divided by current liability. So we'll be take all the amount of the current asset. For example, item under current asset, we have cash, marketable security, account receivable, prepayment, and also we have current or inventory. Alright, under current liability, basically we have account payable, we have trade payable, we have short-term loan, and others that will be related under current liabilities. So we'll be look at on the result. When we get more than one, it shows that the company able to cover its liability. So more than one can be indicate good performance. Right? So the second thing under liquidity ratio, basically we'll be using quick ratio. So quick ratio, the formula is current asset minus prepayment minus inventory divided by current liability. Same goes with the current ratio. If you get more than one, it can be considered as good performance. If you got less than one, it's indicate that those company having a problem to pay their own liability. Okay, these two items will be identified under liquidity ratio. So the next one, we move to the debt management ratio. So basically when we talk about debt management ratio, it will be refer more to how we are managing, how the company managing their own debts. So basically managing debt, it will be refer fully utilize their own, which is they able to use their own debts. Okay. Alright, so when we talk about debt, so basically it can be divided into two components, which is the first one is debt ratio. Those debt ratio will be indicate how many percent the company borrowing in the bank, inside the bank. Okay, so basically the higher percentage of debt borrowing can be considered as poor performance. Most of the company they indicate around 50% of the company will be using those debt management ratio or debt ratio. Okay, another 50% will be on the equity side. So when they have more than 50% or the higher from the industry, basically we can say that poor performance. So most of the companies should have minimum or lower percentage of the debt ratio, because when you talk about debt, if you have higher percentage of the debt, it will be have problem in paying off the interest. Okay, next we move to the time interest earned. The second component that we have under debt management ratio is time interest earned. So basically when we talk about time interest earned, it will be refer on based on the profit that they have, how many percent, how many time they able to pay their own debt, okay, from the interest. Okay, so basically the formula is, you take the earning before interest and tax, you divide by interest. So the higher amount of the time interest earned can be considered as good performance, whereby the company able to pay their own interest. Alright, so this is basically that we will refer on the debt management ratio. The third one, okay, the third main component that will be referred is basically under profitability ratio. So easily to say that profitability ratio, it's refer on how many percent that they able to generate into company earning or profit. Okay, so we have the first one is net profit margin. The formula for net profit margin is net income divided by sales. So basically we want to know exactly how many percent from the profit that will be earned by the company after we deduct all the costs, such as expenses, such as debt, such as taxes, all those things after we have been deducted. Now how many percent that will be left on the company profit? So this is under net profit margin. The higher percentage of debt or the higher percentage of net profit margin can be indicate good performance. Right. Second one is gross profit margin. Gross profit margin is whereby how many percent after they deducted the cost of goods sold. Okay, after they be deducted the cost of goods sold, how many percent they're able to generate from the sale. Okay, so basically we can know that the higher percentage of the gross profit margin can be considered as good performance. Right. Then the third one will be return on asset. Return on asset is whereby the asset the company have, how many percent those assets will be generated into company profit. As we know, some of the firm, they like to purchase a lot of asset, but those assets will be burden for themselves. So basically the good company, those assets that they have, they able to turn into profit. So the formula is net income divided by total asset. So basically we can know how many percent those assets generate into company profit. Basically the last one we have return on equity. When we talk about return on equity, we want to know exactly the capital that will be provided by the investor, how many percent we able to fully utilize those capital from the investor to the company profit. Some of the company, they do not able to fully utilize those capital, and end up it will be a problem, because at the end of the year we need to consider paying the dividend to the investor. So that one, the higher percentage of return on equity can be considered as good performance. Right. That one we have been covered under profitability. The last part basically that will be covered is under asset management ratio. Basically when we talk about asset management ratio, it will be refer the fully utilized or the company use their own asset to generate the company sales. The first one basically will be refer on inventory turnover. Most of the company, they like to have high number of inventory without thinking a long period of time, whereby maybe some of the asset, some of the inventory cannot be sold. So end up it will be a problem for them because those assets will be expired. For example, they cannot sell those assets, they cannot sell those inventory because expired. So this is the thing that if you have higher inventory turnover, if you have purchased 1,000 unit from those supplier, and those 1,000 unit easily to be sell, easily to be sold, it shows that you have higher inventory turnover. You're able to turn from one to another. You reorder more time. So this is basically we talk about inventory turnover. The higher amount or higher time inventory turnover can be considered good performance. Next one, we have day sale outstanding, or sometimes the name is average collection period. It shows that how many days are taken by the company in order to collect back their own amount of money from the debtor. Okay, so basically the shorter period of average collection period can be considered as good performance because we need to make it fast. When those customer buy things on credit, we need to collect it quickly because we want to roll back the money for another project. Okay, next one, the last one maybe we can use is total asset turnover. So basically when we talk about total asset turnover, it shows that how many times those assets able to generate into company sales. We don't want, we have a lot of asset and those assets cannot be profitable for the company. Okay, so basically we'll be compare those results from the industry with the company. Okay, so basically after we have been do this kind of this analysis, we able to make simple decision whether we want to invest or we want to purchase this stock. Okay, so that's all for fundamental analysis.